So we'll call the meeting to order. It's whatever it is, 8:33 on the morning on December 3rd. Linda, before we start, and just so we don't forget, at the end, because at the end, we're going to try to have a little executive session with Kevin, the audit committee. So we'd ask everybody else to step out and whatever the rules are on shutting down the videos. I'm sure somebody will do that or whatever. But, the audit committee's always has an opportunity to talk a little before the meeting. And, we really just wanted to congratulate you on your new assignment. It's, you've done a terrific job for the town. You're very knowledgeable in this particular area. And even though we've got some Republicans and Democrats on the committee, and we didn't know or care whether you were Republican or Democrat, we thought that this next job, while it was good for you and your family, might also be a good step in the direction of something even bigger in the state. So we wish you the very best, and thank you for all that you've done for us and help Norwalk out there in neighboring town. Okay, good job. Thank you. Okay, with that, I'll ask for a vote on the minutes from the October 13th meeting. They've been both distributed and posted. Do we have any corrections or any modifications to that? If not, do we have a motion?
Have a motion.
I'll second.
Great. Minutes. Anybody opposed? Minutes are now passed. Next item is the draft CAFR report. And we'll talk a little about the audit as well. And I think probably the best way of doing this would be to maybe, there's been some comments that have been provided ahead of time. The town is always, particularly the financial staff, taking those comments, and they don't necessarily agree with all of them, but the ones that they do agree with, we talk about, and the ones we don't, we talk about, and then the changes and modifications are made. So a lot of that input has been provided. There'll probably be a little bit more input today, but maybe I could turn it over to you, Linda, and just we're not going to don't take us through the entire report page by page, but take us through maybe some of the highlights if you want, or however you want to approach it.
And Joe, can you hear us?
Yes.
Okay, perfect. Right, so.
Hi, Joe.
Hey, Joe.
Didn't see you up there.
Well, Joe's a busy man now, but Joe's been great to work with, a great partner in going through these processes, going through this process. As you know, this year we were late in at least getting to this stage. We would have had a draft. I think last year we were like 3 weeks behind in terms of getting to this point. But I believe we could still be on schedule and getting everything filed by the end of the month.
From a very high level, what was the delay?
Well, a couple of things.
Very high level.
Sure. Obviously, this year had a lot more happening with ARPA and COVID. There was some additional testing that we were required to do. There was a chart that Joe put together coming from the GFOA in calculating lost revenue, how those are applied to ARPA. So that was something new that we hadn't done before. You'll recall that this year we brought fixed assets in-house. In the past, we had somebody with a fixed asset just send us a report. And so this was the first year that we implemented fixed assets to units, which was something that was a recommendation. So we got that accomplished, but that was an added step that we didn't have last year. So we did that. And then obviously, as you're aware, we've had transition in the controller. And so there were some questions that needed to be answered and postings that we could not give Joe an answer directly. Some things we had to reach out to Joanne. When she was available, she would respond. So there was those types of things, but really had to. And then obviously on Joe's end too, he's had turnover. Catherine, who's been our point of person, is on family leave. And so there was some of those things. So there was a lot of back and forth that kind of led to that. But all the issues were resolved. They just took longer.
Okay, good.
And I think our goal would be to try to progress with the plan schedule. Right.
Okay, great. And I think we can get that accomplished. Yeah. So in terms of the audit itself, I'll let Joe speak to any findings or from an audit perspective. But from our point, we included in the MD&A kind of a summary of the things that happened. The net position increased year over year, which is kind of normal just because of the nature of business, fund balances, assets that we own. And so we had that. That happened. Our long-term debt, which is stated on page 17 of the MD&A, that dropped this year partly due to timing. We retired bonds and we hadn't issued any as of June 30th. As you know, we did go out for a bond issue this week. So we issued 25 million in new money. So that would be new to this, but then we would also be retiring an additional about 13 million annually. So that would change the debt picture. But as of June 30th, we did have a net decrease year over year comparing those.
One thing, Linda, on the page 17,
Yes,
and that opening paragraph,
yes.
I know I had some comments, and I know that George did, but I know from our general reaction was, maybe there's a better way that you could have a summary of the 14 or 15 million increase in that position. That would be our thinking, and be happy to put forward, a thought. Obviously you do what you want, but for at least from my perspective, I think there could be a better way, or a more understandable way of getting that point across, but that's.
Sure, we could get to that. If you look on page 21 of the MD&A, the last bottom right-hand corner, the last two numbers.
Mhm.
You see 2020 199 and 2021 213. That's essentially the delta. That's that 13 million. And so if you would like us to kind of further break down this into
Yeah, my issue was more with the table and an explanation of the breakdown that's more, maybe, at least from my perspective, easier to follow. But we can deal with that, not
Yeah,
here.
we could change it.
Okay.
And Joe, if I recall, this table here was one we added last year, right? Based on feedback, because we didn't have this bullet before, correct, Joe? On page 17?
Correct, yeah, the numbers, I could show you where they're coming from, but we can certainly.
Whatever, we can take it offline. It's just something that, I don't know how others feel, but it's the first thing that shows up, and to me, it's hard to understand.
We can definitely go break down the 14 million and provide a summary of that.
And I sent in my email, a thought. Okay, sorry.
I don't know, Chuck, would you rather me just go through, or do we?
No, do what you're doing. I just thought if there's something, and there won't be a lot, that we want to, highlight or something, we will.
So the net position did increase 14 million, and so now I'm on page 18 and 19 really is just definitions. This is the same information carries over year, defining financial statements, how they're organized, the fund groupings, governmental, proprietary, fiduciary. And then page 20 is a high level overview of basically the net position, breaking it down by the big categories: capital assets, long-term liabilities, and the bottom number again is that same number that we just talked about, the 199.1 million. Page 21, it provides that same information, position, but more over program level. And again, we break it down, and the net is at 14 million, which we can further redefine on the front page of page 17. Page 22, we talk about.
Sorry to bother you again.
No problem.
So the this you want to call it restatement that took place, is that something as you progress that somehow will maybe go through what that was? And I don't know when the right time to do that is, but at some point, I think it'd be good to understand what
Joe,
what
could
the
you speak
restatement.
on the restatement? The 199 million, the restated.
It was like $300,000 or $400,000, right?
So that's old. It's 1.6.
Right, if you want to look at page 98, and it's the last footnote, so basically due to GASB 84, student activities and related type things were reclassified from custodial or it used to be agency
What is
revenue.
Joe, what do you want us to do? Go to page
90,
98?
98.
Yeah, Exhibit K.
what is 80, whatever it is?
It's a prior period note.
GASB 84, what is that? Just
It's a statement that
unless you
Joe, get a
know.
little closer, Joe, get a little closer to the phone, Joe.
it's a statement on, has to do with fiduciary funds, how much related to pension, and other fiduciary type funds like student activities is a fiduciary fund or was in the past, but under the new GASB 84 definition, it's now more a special revenue fund. So basically it's just reclassifying that amount from fiduciary, which are not in the government-wide statements like pension and private purpose trusts. So, and student activities previously didn't roll up to the top statements because they were fiduciary funds and conceptually restricted. But once it was reclassed to a special revenue fund, that now it's going to show up in the government-wide statement. So it's just a fund reclassification based upon the definitions of fiduciary funds in GASB 84. So it just changed the way it was presented last year to where it's presented in the audit this year.
Okay, so it was moved, let's say, out of the financials into the pension, or if that's the right way to look at it.
Yeah,
Government-wide.
it wasn't governmental, and now we're accounting for it in governmental. So
It was in fiduciary and now it's in government.
Right,
now it's governmental.
correct.
So it's just
Primarily the Marcelli Scholarship.
So what does it relate to?
It's, well, one of the biggest components is the Marcelli Scholarship Fund that we're managing, and it goes to a student every year for their college education. That's about, I think it was they just took my notes, I'm sorry. I think it was
Oh,
about
I'm sorry.
$1,300,000, $1,400,000 of that $1,600,000.
So why was it reclassified?
That's more of, it's related, as Joe was saying, to GASB 84. It was how we have to account for it, I guess, Joe, because of the size. It used to be a standalone fiduciary fund, and now it's part of going on the government-wide financial statements.
Maybe there could be a suggestion, might be is a little bit better explanation lead into this
I think
Right.
that makes
to this
sense.
footnote to better explain what 84 is and why.
So
know,
we'll
exactly what-
elaborate on what
Kind of more elaborate
84
on what it is
required.
and what the impact was, it moved it from this fund to, whatever the right thing
So is
is.
that explanation better placed on page 21 of the MD&A or in the footnote?
I think this should, to me at least, I think the footnote's
Footnotes.
fine,
It
but
should go in
refer to
footnotes,
the footnote
because-
somehow. But I think a better, more robust explanation of,
So do you have less? So which fund is it in now? The general fund?
No, it's still in the same fund. It's still in the same fund. It's not didn't move to the general fund, but governmental funds is a grouping of funds. And so we have it in three groupings. They're either governmental, fiduciary, or proprietary. And fiduciary are like
It is the pension and all that.
right, so the pension and the OPEB, so those are there. So basically what we're saying is the fund total stay the same. It goes from being, it wasn't considered part of governmental grouping of funds. And now the governmental accounting standards board saying that it should be. It was just moved from one fund. But it's not the general fund. The general fund.
So whatever fiduciary responsibility we have for this pension, for this scholarship fund, none of that's changed.
No,
No.
nothing, none of that. Operationally, nothing has
and
changed.
part of my issue was, I think the number changed, right?
Can I ask a question, Chairman?
That was-
So what is the difference between the 198 opening balance, 198 million on page 98 and the 199.1 on page 17? That was a question I put in an email yesterday. Total net position as restated, 199, 138 on page 17 and also on 21 now, and page 98 has a different number.
Right, I think because originally that restatement number was picked up incorrectly. It was picked up at like
Right,
343,000.
that was my problem.
And that was wrong. It should have been, as Joe corrected, last night, it's 1,000,006 and change. Now I have my notes. That's all. So that's why the beginning number was jumping around, because the restatement number was picked up incorrectly.
All right, so we'll make sure that all the numbers tie in and stuff.
All right, you'll do that.
I think the main thing was to probably better explain
Explain it.
what
Sure,
it
we
is.
will make that section more robust.
Sorry,
Okay, so back to.
I'll try to keep it down.
Back to page 22. Is that where we were?
So we were on page 22. On page 22, we kind of discussed the variances. We don't just go into every single one, but we talk about the major one. So the first variance we discuss are charges for services. There has been a net increase from last year of about 1.5. And net revenues that are included in that include the drivers, our conveyance fees, and this is conversation we've had before. For purposes of this grouping of the reports, conveyance fees are grouped under charges for services. So we know that this year we had a significant increase in conveyance fees on the budgetary from 1.9 to 2.8 million year over year. And this is when properties exchange, partly due to the strong real estate market. And then we also had building permits, park and recreation fees were impacted last year because of COVID. This year, they're picking up again. So those are the two drivers, the significant drivers for charges for services. Operating grants and contributions, you'll see that that also increased year over year to 2.2 million. Again, the driver this year are the funds that the town has received related to COVID. The ARPA also accounting for funds on the Board of Ed side. And so we received a total of 2.9 million in ARPA funds, 480 Corona relief, and then the Board of Ed received 99,000 in patient stabilization. So that's what's driving the operating grants year over year. Property tax revenues this year decreased. That's largely due to the budgeting. We increased the use of fund balance year over year. We kept the mill rate flat year over year. The budget relied less on taxes than prior year. So that's what drives that. We talk about changes in investment income because that did have a significant decrease. And Andrew provided some insight into this as well. He includes verbiage there of what happened with the markets and whatnot. One of the things that the Board of Finance is looking this year is exploring with the transition to JP Morgan. How can we leverage how we hold funds to get better interest? Looking at cash flows, we have a lot more funds that sit idle, and perhaps we could be a bit more aggressive in our investments as opposed to just having them earning the minimal in the money market accounts, maybe lock them up in CDs longer term. But the Board of Finance is looking at that and looking at cash flows to determine if that's something we could do to increase investment income. It is challenging in this environment, but every little thing counts, and so we're looking at that. And then on the Board of Ed side, maybe Joanne, you could speak to that. There is a net increase of a little over $2 million year over year, but
so the increase in our budget year over year relates to the non-lapsing account for COVID, which was 1.9 million. The appropriation, we spent 1.6. So we carried over 300,000 into the current year. And then after the budget was approved last year, the town finance board and town council approved an appropriation into our budget of 1,977,000. It was not for expenditures in 2021. It was to fund the internal services fund for anticipated claims in 21-22.
and then the final thing we talk about there is under public works, we say expenses decreased. In governmental activities, we also look at capital budget. So those projects that fall under public works. So not just the operating budget, but we spent less on capital projects just due to timing and when projects are done. And so that's the driver of the decrease in public works. On business types activities, really it's just a pool. That is our only business entity. And year over year, we've had nominal increases in pool activity just because they were shut down during COVID. they're picking back up. It's not significant, but we have seen some increased revenues and increased expenses, but not by significant. not by
One thing that hasn't gone down are health benefits. Is that accurate?
Sorry, what was it?
Said one activity that has not gone down but gone up rather significantly are health benefits in both the town and the Board of Education.
Yes,
Just
and
a
there
little-
is a schedule, and that's a good point. I'm trying to see what page. it is.
130 something for internal
Thank you.
services.
Yes.
Mhm.
So if you turn to page 130, and this was something I was going to bring up as well. 132. On page 132 and actually 131. Let's look at page 131. But to your point, if you look at page 131, you'll see this year the ending balances. Let me start on the Town Health Benefits Fund. Total operating expenses of 7.2 is higher than where we were last year, because I believe last year on the town side, we were at 6.4 in operating expenses. This year, we're at 7.2. And then on the Board of Ed side, where this year we see 15.9 million, last year we were at 12.4. So there has been activity. Some of that, and our benefits advisors have told us, some of that is COVID related. There were some procedures that were delayed last year, especially the elective types, because hospitals weren't taking people in for those, just for emergencies. And so as those restrictions are being relaxed, we're seeing patients go back for some of those elective things that were delayed. And so that's driving that. And then there's cost as well.
So how do you read this page? What is the first line? Changes, charges for services. What does that mean?
So charges for services in the internal service fund component are revenues, because we self-include. So we fund these internal services fund primarily from three sources. One is the town, from each of our respective general funds fund into the internal service. We have employee contributions because they provide their share into the internal service fund. So I think those are the two primary ones that go in there.
That's sort of the,
So
so that's sort of the amount of money that individuals put in, or the town or the board puts in to fund the pension costs. And,
Health insurance.
I'm sorry, the health costs. And so how many employees would the Board of Ed have, ballpark, and how many would the town have?
The board has approximately 660 employees, and we cover 1,500, give or take, members, which would be the dependents.
With their dependents, that's a good
Right,
point.
so it's close
660
to
plus
1,500.
15.
Right.
Would you have those comparable numbers?
I can ask Cheryl, I don't.
Well, we have about 180 active employees, so not everybody's in the health plan, but a better part of them are. And if you just say some of them are singles, some of them are employee plus one, some are families, I guess the lives would probably be in the 500 range.
So 170 versus 660, so it's about 25%. And if you assume the demographics of the families are the same, but the charges for services are for the town 50% of what they offer the Board of Ed, or to say it differently, the Board of Ed is twice as much with 4 times as many people in the population.
That's correct, yeah.
So just analytically, you have to realize we couldn't answer that question now, but analytically, the charges for services, doesn't equate to the number. If you say you had 200,
Yeah.
then we had 650, ballpark number. So that's about
Should be
a
a
third of that, or well, say it differently, 25%, 75%. But the charges for services are
On the health side,
maybe not off that
Just about
much.
a third.
I make a
About a
comment?
third.
on
No,
the
not
health
that much.
side, what exactly do the consultants do, and how much are they paid?
Can I make a comment, George?
I'm sorry?
Could I make a comment? So the town went self-insured 5 years ago,
Mhm.
4 or 5 years
I'd say
ago.
that's correct.
And for the first 3 years, being self-insured, you're an insurance company. And we buy excess, what do we call the excess?
Stop loss.
Stop loss. We buy the stop loss to make sure over a certain limit, we don't get killed. These days, when you have lung transplants or heart transplants or a preemie baby that costs $2 million, because of the Affordable Care Act, there's no cap on the expenditure for a particular case. We've had very bad experience in the past 2 years, both in the town employees, the library employees. The Board of Ed has been self-insured for like 12 years. And for the first 10 years, they had great experience. We saved a lot of money. The town saved a lot of money in the first 3 years, 4 years. We ran into a patch with some very bad, one was COVID related, a lung transplant, those kind of things cost a lot of money. But over time, and because the town is such a small population compared to most insured groups are much larger, and you can spread that loss. But so we're experiencing a bad period. We expect things will return to the norm, but that's why when you're self-insured, you're going to experience that.
Thank you.
So if I could speak to the board's
Yeah.
portion of this fund. As Kevin said, the self-insurance is the appropriate way to go. Over time, it's going to save you money. When you have good years, you benefit rather than the insurance company. So it definitely, and you don't pay a lot of taxes that are embedded in a fully insured program. So it is the right way to go. Over time, and we went into detail in the MD&A on this fund so that you have a good sense of where we have been and where we think we're going in the future. It's key to the management of our budget. So over the last 6 years, we've onboarded all of our unions from the PPO plan, which is a high cost plan, to the high deductible health plan with an HSA. So the HDHP with an HSA. So once we onboarded and concluded our onboarding, which was in 1920, we've restabilized or reestablished the floor for our claims. And we knew that was happening. We were able to use a lot of the savings over these past years to offset our budget increases. So once that floor was established, we knew that we would no longer have savings and that we would have to start just funding our budget on a flat basis. So in 1920, we offset our contribution from the general fund as the revenue coming into the internal services fund by $2.6 million. And then after that, we felt that we were going to be having to increase our budget every year by some trend amount of money.
Right.
What happened in 1920 is we had COVID came in March and our claims fell off the cliff. We saved $2.6 million in those 3 months, and that built into the fund balance. So fast forward into this current year, we use that money to offset any increase from our operating budget and help with the tax, keep taxes flat.
Right.
One of the things that also happened, though, is that we had to accrue for restabilizing the fund at the new floor. And that is why the Board of Finance, rather than putting it in our budget last year, they did a special appropriation in April for $1,977,000. I'm sure everybody remembers that. So effectively what happened was we transferred that money last year into the Internal Services Fund. And as a result, it looks like our expenses went up $2 million on the operating side, but they didn't. Those funds were transferred into the Internal Services Fund in anticipation of claims this year, which are materializing.
Right.
So we have to work with the Board of Finance moving forward into next year's budget to figure out, to have a plan as how do we mitigate not only 2 million in this year, but any trend moving forward, because that's going to really be a significant budget increase.
You're really at a high level. What's in the administration line?
The administration line is basically the costs that we incur to administer through Cigna and our stop loss. Basically the stop loss cost.
The cost for that?
Yeah.
What would that be, ballpark?
So this year it went from 750,000 to 1.1 million because we actually collected approximately 1.8 million last year in stop loss insurance. It was a huge loss for them because of a lung transplant and a cancer, different high cost.
So the
claims
true
that we had.
administration cost is about 300,000. The cost of the insurance company doing the administration here is 300,000 or whatever.
Yeah,
Something like that.
and they net out the RX subsidies from that and so forth.
And on the stop loss, the same on the town side. We buy stop loss coverage and then we're capped at was 100, we went to 150 this year.
Correct.
So anything over 150, the stop loss carrier carries us. This year, actually, this past year, when we did the analysis, we came out ahead. They paid a lot more in stop loss than our premiums. So that's to answer your question, George, and I asked Cheryl to come. The first part of the question is how many employees? It's 521 employees plus dependents.
I was pretty close at 500.
So that's what we have there. But then Cheryl, you can talk about Larry and some of the work that they do in the process.
Right. What Larry has done for us is every year he helps us go out to bid. So we are looking at all carriers, deciding where our self-insurance is compared to a Cigna or United Healthcare or a state plan. He works with the rep on the Board of Ed side. He and the Board of Ed rep helped us to get a general stop loss carrier so that we're sharing that. Know that they're looking into the pharmacy part of it to see if there's something that we might be able to save in regards to that. They monitor our claims every month. We do meet with them every quarter to kind of look at what some of our concerns are going forward. So
Right. During budget development, they help us develop the budget. They look at claims history, projections. I mean, they have charts and analysts that do this. They look at our claims, they look at our age distribution and kind of try to give us a best estimate of what our anticipated claims are going to be. So that's what we hire them to do.
and
just,
before
yeah,
negotiations too,
right.
they will meet with us to kind of tell us what levers we should be pulling so that we can show a savings when we negotiate.
Yeah, it just seems to me, and I don't want to take us into a 20-minute discussion because without an end in sight. But it just seems to me now that the town, the Board of Ed have both fundamentally decided to do it the same way, right?
Mhm.
That, I mean, I have no idea why you couldn't just do this once with, one person on, administering the claims and one person going out and testing the market. And then the Board of Ed or the Board of Ed could do, I don't care who did it, just, allocate it back or just put it in a separate budget. So you take the intramural sports out of it. So it doesn't affect the Board of Ed budget. It doesn't affect the town budget, but it might actually save us a little money. And as you said, when we're talking about the pool, not a lot of money, but every little bit helps. And same thing here. I just, as I said, I don't want to get into a big intramural on it, but it would seem to me we just probably maybe could save at least 50,000.
We've had that conversation. Board of
Good.
Finance and Board of Ed had that conversation. Other towns do it that way.
Do they?
I think Norwalk does.
Norwalk does it that way.
Greenwich does it that way. And so,
We could have kept Linda here if you guys would have got to this a little bit earlier.
So there's something to be said for that. It's not saving $50,000 so much as, trying to plan your budget overall because, if one is going up, one's going down.
Yeah, but I mean, if you think about all the intramural sports, we had around the 1,997,000 or whatever, with all those, so it's just, at the end of the day, it's gonna all come out of the same.
Taxpayer.
Right. Did you say that it's going to be done, or did you say
No,
it's?
it's getting it done is another thing.
It's been discussed, but not.
And I'll just add to, in a spirit of cooperation.
Say it again.
There's
I'm
always
sorry.
reasons why things.
Oh, I'm
are
sure
done.
there is always reasons why I can't do it. Like
I
said, we're
can
not
cite
gonna-
a one that was just recent. Where some hands were in our pockets.
That's right.
So-
If you.
I do forgive you for it, but it was a
If you
big
looked at it,
number.
if you looked at it this way, if you got a group of taxpayers together, a couple of Republicans, a couple of Democrats, a couple of people in charge of who love education, a couple of people who don't love, a couple of people who love the town, yes, then you
We all love
put,
education.
right?
Yeah, we all love education.
We all love education, exactly, but there's a diverse group of town, right? So you never know. And you got them together and I bet you they would come up with the answer of saving that, taking care of our employees, doing the right thing, but saving a few dollars from the administration of it. And it's not even firing a town employee. We're just gonna have a hire less consultants.
We do buy the stop loss insurance together.
Yeah.
So we
That
make
was
progress to get to the goal.
Good.
That's been helpful. I will add too that last year, our consultant did an analysis of the savings from moving from the PPO to the HDHP over the 7-year period, and it exceeded $10 million.
So I think what you're doing makes,
10 million.
10 million.
I think what you're doing makes great sense. We could just take it one step further. But anyway, as I said, we're not gonna resolve that today.
Yeah, no.
We probably could if Ryan was here, but.
It would have been more definitive.
Bill, just as a comment, I think you should expect the healthcare costs to go up. The major hospital companies, HCA, Tenet, Community Health, the public ones, we got data, they're all doing really well now because during the pandemic, there were just a lot of elective procedures weren't done and a lot of people didn't have tests done. And all of a sudden their cancer and a variety of other things are really flaring up. So expect it.
It's saying, not for more tests, but from people now identifying diseases that.
Yeah, I mean, the number of mammograms done fell by 40% or something in the nation. And as you would expect, the number of breast cancer occurrences have gone up by 40, 50, 60%.
Well, we saw our claims from just July through October go up 100,000. So.
Yeah, it's good. It'll keep going for a while.
Okay, great. Thank you.
And I'm almost done, and then I'll toss it to Joanne for the Board of Ed.
Okay, I'll wait.
So on the general fund side, on page 23 now, just some budgetary highlights. This year, we did draw down on the general fund 5.2. The general fund decreased 5.2 million. That was by design through the Board of Finance, as you recall. We did, as Joanne mentioned here, the Board of Finance approved 2 special appropriations. There was a 1.9 million additional after budget was approved for funding the internal service fund. And then we also funded $1.5 million for the COVID non-lapsing fund. So these were funds from the general fund into either the non-lapsing fund or the COVID, the internal service fund of the Board of Ed. So our ending balance was brought down from 34 million to 29 million as a result of that. The unassigned fund balance right now within the general fund is 8.9 million, which includes set aside for next year's budget. So in terms of ratios, is that good, bad? The GFOA recommends about 16.6. That puts us at about 17.2%, so we're slightly over the GFOA. But you could make the argument that our fund balance, it is a healthy fund balance. And so you could make the argument that it could go down some and reduce reliance on taxes moving forward. But that's kind of the highlight of the general fund. And then the other variances we talked about, I talked about the fund balance, our tax collections continue to remain high. And I talked about the special appropriation, and maybe Joanne could go into the Board of Ed side.
Sure.
Unless there are questions there.
So as a reminder, when we were putting together our budget for last year, 2021, we were pretty much through the whole process when COVID really hit here in March. We adopted the budget in late March, but our numbers were all built based on normal operations. So we knew that going in that we probably would end the year with a balance left in our accounts.
That just help me with the calendar. In March, was that when the world began to shut down?
In the US, yeah.
Confused the years these.
Yes. Yes.
It was March 12th that we went out and went remote for the rest of the year. And of course, at that time, we were planning on being out just 2 weeks. And then we went right through the end of the school year. So our numbers were really based on our traditional program. And so we anticipated having funds remaining at the end of the year. We didn't know how, what that number was going to be. So we made the decision to really work with a non-lapsing account to account for the COVID expenses so that we had a true picture of what was remaining in the operating budget.
Joanne, I think we're on what, 25?
Page 25, yeah. So as you can see, we underspent our budget by $1,340,000.
You really need to look at this deal, the new package.
And if you go down, you see the original budget was 90,886,28. And the
That's a new
additional
number.
transfer in, so this does not show the non-lapsing account. That's accounted for in a separate fund, but it does include the amount of money that was appropriated for the internal services fund. Because the transaction is that we expense it in the operating budget and then we move it in as a transfer into that internal services fund. So at the end of the day, that transaction did occur. And as you can see, if you look under transfers, the second line up, a total of 2,315,552 was moved into the internal services fund in addition to the original appropriation. And that's because at year end, when we closed out the books, our claims for last year were higher than budget by 90,000. We had an additional cost and stop loss for this current year that we wanted to fund of over 100,000. And then the IBNR in the fund went up by almost 200,000. So we funded that out of this budget here, the 2021 budget, but the expenses actually were anticipated for 22-23. So it gets a little bit confusing when you're starting to take a look at this. So just moving down, just to let you know, our salaries actually were underspent by 1.2 million. And a significant amount of that underspending is related to the fact that we had quite a few people out on FLMA. And the federal government actually passed an act to extend the benefits under FLMA. And our employees, we had a core group of employees that did end up staying out, either for their own reasons, their own illnesses or family. And that really impacted us operationally, as you can well imagine. We, through the non-lapsing account, we hired permanent subs for our building, which were tremendously helpful. But we couldn't get people to come in on a daily basis to sub because they were afraid to come into the schools. So it took a lot of creative thinking to pull people from other areas that weren't directly instructing students to be in classrooms with kids to ensure that they were safe.
So those FLM or whatever the right word is.
Family, yeah, medical
costs
FMLA. Yeah.
that were incurred to reduce this, those were paid by a government program?
Right. So we have,
Not
our
the
employees
town.
are entitled to X amount of sick days and they can go out on that and then they go into unpaid. Well, the government subsidized an additional 12 weeks at a fixed amount. I think it was 500 a day. So, you know, at max 500.
So
a
you've
day.
got
So,
lower costs, but
Yeah.
it got.
so the
funded.
people, so we couldn't even find people to replace them. So we were pulling in from our reading specialists, our librarians,
kind of what
our
we're
guidance,
seeing
you
in a
know,
lot of
anybody
places
that we
around the
could
world.
get.
Yeah.
And so we weren't incurring expenses.
Yeah.
So
As the announcement of giving employees a benefit stipend, which I guess Kevin just announced, at least it was in the paper because of COVID. Has the details of who's getting that, is that public or is that something that's?
we have not made our list public until it's approved, fully approved on the 15th.
Methodology is not public.
So, but all of these factors were considered when setting the amount for
That
individual.
was my point.
Definitely. So yes, and we're extremely grateful. I mean, our employees are really feeling, you know, appreciated. So we're very happy for this. So the health insurance, we did go into quite detail in terms of employee benefits. And from our perspective, Brian and I wanted to memorialize what's taken place, you know, in this report, because as we move forward, it's going to be important that we continue to work cooperatively with the Board of Finance to figure out, you know, how do we really approach the funding of the Internal Services Fund. It's such a great tool. It saves so much money, but now we're at a critical point where we have to figure out the financial plan moving forward over a period of years to get it where it needs to.
So with respect to the budget year that we're in right now, which I guess is the year end of 22, right?
Right.
We have an amount in there for internal costs or insurance costs. I think we have a general consensus, we take a vote, we have a general consensus that healthcare costs will be going up. How has that been reflected in the budget?
Well, we're developing the budget now for fiscal year 23. And I think if we.
22, but 22 will have higher costs, right? Maybe not higher than the budget, but higher than the prior.
Right. And so we attempted to do that. Part of that is this 1.9 million that Joanne talked about, the internal service transfer that was done last fiscal year to fund these anticipated expenses this year. But we're going to be tracking that and monitoring that to make a determination. Is that sufficient for the year? Or will the Board of Ed need to come back and ask for additional funding? And we're doing the same thing on the town side.
I think, am I right that it could, you know, I mean, we don't know. It's just, yeah, but am I right that it could be, given the cap for the long operations, if it could be a big number?
It's 20%. So our maximum exposure is 20% of our claims. That's set by Voya jointly when we get into the new plan year. And so that's our maximum exposure, is that 20% of claims. In our case, our claims are budgeted at 13.3. So 20%.
If claim doubles, then went to 26, it's
about 2.6 million or 2.
went to 26 million, it would be 13 million increase, and it would be 260,000.
2.6 million.
2.6,
6
yeah.
million.
2 million.
So the way that's handled is we have a reserve policy with the town, and we retained 40% of the 20% corridor
Right.
in the fund. And the town puts aside the 60% of the corridor. So for this current year, and that's always been the goal, that we cover our maximum exposure in the funds. And so that's where the plan, that we work really closely with the Board of Finance to ensure that the town is not at risk for any kind of overruns. Now, on the board side right now, we're 5 months of claims, and as Linda said, we watch it like weekly to see where we're at. We're about 65% expensed on claims on a net basis. But we watch our high claimants, and so as we get closer to the end of the year, if we have concerns about dipping into those reserves, we'll be speaking with the town. And it's happened once in my time here.
So on your audit, if you look on page 68, to that point. 68, you'll see in the general fund column, we set aside our share of the corridor as part of the assignment. So you see towards the bottom, under the assigned categories, there's health benefits. You see health benefits. Yeah.
1,613.
So that's the town's portion of the corridor. So we keep that in the general fund. The Board of Ed has that portion service, but that accounts for that maximum exposure. If we exhaust that and we exhaust this, then we would be looking at some type of that's what triggers our.
But the risk to the town from a budget standpoint is 20%.
But we're covered.
Yeah,
We're covered on it. So we really don't have, we've funded the risk, basically.
Yeah.
And that's always been our goal, because the Board of Education in this particular instance has some personal exposure if it's not funded, so.
Can I make a comment?
Sure.
Part of the issue is timing, because when we start the budget process, we're looking forward 18 months effectively for when the health year will be in progress. And you're actually on a September calendar rather than a July calendar like the town is. It's very difficult to project that far forward where health expenses are going. What the Board of Finance was talking about was, let's go to a corporate model and true it up every 6 months, sit down and, see where we are. The consultants monitor our experience now. Then as we go into the budget season, by March, they update the projection, but we're still projecting way forward. It's very difficult to be accurate when you have that longer time period.
So if you're in,
But we have stop loss insurance, so that we can't have a huge loss.
yeah, that's the good part.
Yeah.
Yeah, so if I'm a town employee and like my own personal insurance plan, I have an insurance policy, but there's a deductible, and I pay that portion myself. So the town has a deductible for all their employees.
Right, 25.5, 2250, I'm sorry, for a single, and 4,500 for a family.
2,250 for a single person, and
Yeah.
and that 2,250, the individual pays themselves 100%. The town doesn't reimburse any of it.
No, we do 50%. We do 50% of the deductible. That's part of our cost, our program.
Town as well.
Same.
So it's not, so it's so it's 2,250, but the actual cost is only, it's not 2,250, it's 1,125,
Town's a little bit different, but,
right?
well, we do 50%, but our
Right.
deductibles are a little bit different.
A little bit different.
But we deposit those
Which is a
funds
pretty-
in the
which
beginning of
is
the year.
Pretty low deductible. 1,000, I think. I mean, I could be wrong, but I know Robin and I are working on something else for insurance, and it's, it's a little different situation, but the,
Yeah,
yeah, that's fine.
yeah, it's a generous deductible for the employee,
That's part of the negotiation with the contract,
of course.
collective bargaining.
That's all part of the contract negotiation. I didn't get there yet.
Yeah,
All right.
Well, I mean,
All right, so I can move on. Yeah,
it's everybody has something different, so it's, I mean, every organization has something different, so it's impossible to say what's fair. But, I mean, in this other situation that we were involved, what we did is we increased the salary, but took, but impacted the deductible. Because if, thinking that if you gave three people $1,000 in cash, they might control the expenses a little bit, a little more. I have no idea whether you have the opportunity to do that, but there must be some human resource person can tell you there must be a point there where it has an impact.
yeah, we follow the same procedure. I mean, it's the salary on one side and our side is leveraging with benefits.
Mhm.
And we have a 90-10 over the deductible as well, and an 80-20 out of network. So, which is pretty much unheard of in the public sector in Connecticut. So we're one of a very few districts that have that additional out-of-pocket expense for the employees.
Additional 90-10 gives the employee more.
No, so anything over the deductible, they incur the first 10% of the total cost over the
Okay.
deductible, which is unusual. I mean, it's a kind of a private sector
Right. I agree with that.
approach.
Yeah, that's good. Okay, great.
All right,
Moving on.
so moving on to page 27, contracted services. Again, we've been impacted by COVID in some extraordinary ways. Interns, we could not really find. The state of Connecticut paused on testing, which didn't, saved us some money. Athletics pretty much were a very skeleton type of program last year, unfortunately for our students. Outsourced services, the document reproduction, obviously, when we weren't in school as much, we didn't use our copy center. And occupational PT was limited last year. And then going down, property services, we actually had an increase here. We did expect an increase. The cost of energy went up because of consumption, ventilation. The buildings went from being controlled in terms of ventilation to just, we had to open everything up. So we expect the same thing this year because we're operating pretty much much the same way. Going down, one of the things that you should be aware of that we did do was we really took a look at our network security. We felt like we had a really strong cybersecurity program in place, but we really, once kids were learning remotely and in hybrid, we wanted to make sure that it was as seamless as it could be in terms of disruption. So we upgraded our firewall from a Cisco to a Palo Alto, which is pretty much gold standard. We replaced our backup systems with a rubric. So which means that once the data is written to it, no one can get into it. So even if they brought down our system, they couldn't capture our data. We're the only ones who can capture the data, which we thought was a really good move. And then the last thing this year we did was we updated our antivirus. So we feel like we have a really solid system in place. It did cost us some funds, almost 200,000 between the two fiscal years, but we thought that, we really felt like we needed to do that.
I
To
encourage
stay
you
safe.
to, no matter how good you think it is, to do it again. Ed, you probably saw or will see a similar report. He and I have another life in common, and the federal government taking a cross view of a number of institutions and, spending billions of dollars and,
Mhm.
and you get the report of, the ways you can still be cyber attacked.
I know.
So it's impossible to be fully protected. If
It is,
anybody says
yeah.
they're fully protected, it's just not possible to be fully protected. So you couldn't spend enough money. We don't have enough money to spend. And even if we spent it all, we still wouldn't be fully protected. Having said that, I know you're not going to, Joanne, but don't rest on your laurels on this. This is
No.
something that you have to top of.
So we work closely with the town, Chris Kaiser here on the town side with our team on the school side. Between the two of us, we can see who's knocking at the door pretty much, but it doesn't mean that one employee doesn't click open an email and just let somebody in, a bad player in.
Also, so when you talk about clicking on the email, letting somebody in, that's a cyber attack, right?
Mhm.
But the big focus in business today is the damage that an employee can do, not inadvertently letting somebody in,
Mhm,
the damage they can do as a rogue employee.
mhm. So a lot of our systems are
Copying information,
protected by
taking away.
rights. Yeah. And it's not to say that somebody who has access to certain data won't pirate it, so to speak.
Right.
But yeah, I mean, it's something that we think about a lot, especially with kids on devices and, what's out there, the harmful stuff.
There will be
that's out there.
technology that will not permit people to take camera shots of screens, things of that nature, but it's still another 2 or 3 years away from coming
Mhm.
out.
Yeah. So moving down
Get to see that
to,
cyber report yet? You wrote.
So moving down to our supply accounts, we did purchase a lot of our one-to-one supplies through the non-lapsing account. So we did have some funding available here. We did have to invest in some equipment, cleaning equipment last year. We purchased 2 Type 2 vehicles. You probably have heard that we might be changing our start and end times next year. And so we were looking at the contract. We actually renewed our contract with DAFWA at a 2% increase each year, which we thought was really good, actually, compared to what our neighbors are spending on contract extensions, if they can even get them. Our vehicles are less than 5 years old. We can get at least another 5, so we went for a 5-year extension. But we do have 2 drivers that drive our white vans that are CDL licensed to drive buses. So we have 2 of our 20 drivers that are licensed.
2, but then all the others are serviced out.
Well, the other ones are licensed to drive an SUV with students. It's called an S-Rider, but these 2 folks can drive a regular bus. So we brought 2 buses. They're 60,000 plus each. And they're going to be used to kind of go to the outskirts of town where it takes 10, 15 minutes to get to and pick up those children, while the bigger buses are in the more concentrated areas, because our time between tiers is like 30 minutes, which is virtually impossible to do without some creative thinking. So that was the purpose for purchasing
You have a
those
lot of
things.
kids that don't get picked up, or don't avail themselves of the service, but you sort of have to provide it anyway, right?
Well, we have really good ridership. The way that we route the buses is we assume that they're not going to be fully utilized. So we use ratios based on areas of town that we've collected over time, historical data. And then as we get into the school year and run the routes, if we're short, then we tweak in between adjoining buses to bring them on. So for example, we currently run 4,200 roughly students on 36 buses. When I was in Weston, we had 22 buses for 2,200. So the system we have here is
Yeah,
pretty
that's good.
efficient.
That's good. Great.
And we use a software program that is really well developed for the roads in town, speed limits, traffic lights, stop signs, and that sort of thing.
Maybe if you could pick one or two more items you want to highlight, and then we can flip back to.
I think that's it. One of the things that we did were impacted by was, we have an extremely generous community here with the booster clubs, the athletic booster clubs, and of course our gate receipts. Last year we took in less by over 100,000 because we weren't running sports. So this year we're rebounding, and that's a good thing. The one other thing that is not right here and here that in this document for the MD&A that you should be aware of is that our school lunch program for 2 years has run a deficit, which is unusual in the last 6 years because we have been running about $250,000 profit each year, which is put aside to replace very expensive equipment, as you can well imagine. But for the last 2 years, we've run deficits of about 400 each year. There was a sufficient amount of funds in the fund itself to cover the loss. But moving forward, our fund balance has been depleted, but has taken 2 significant hits. So we're going to be keeping a close eye on that to make sure that there's no need to supplement it from the operating budget. But you'll see that as you review the statements.
Kids pay for that, right?
I'm sorry,
This is which budget is that?
the
Food budget?
food service program.
So why wouldn't you just increase the price?
Well, the reason is that we have to have sufficient resources in the fund, and we've really taken 2 years of losses.
No, I'm saying, but if you have a deficiency,
Mhm.
why would you
Raise the price of the,
why just raise the price of the food?
We could do that,
Yeah.
but it has to do with, well, this year we have rebounded. But when you take a look at the financials, you're going to see in the special revenue funds, 2 years of, and it might be a red flag for you. So I wanted to mention it.
Yeah, okay, yeah, but I just, raise the price of funds. So I want to just, I never told the audit committee this, but I became aware that they, guess for the Turkey Bowl, they were selling tickets for cash. And I immediately, actually, I first called Brian, but he was in a meeting. I didn't want to pull him out of a meeting, so I called Joanne and said to Joanne that, she was all over it. She had control of the ticket numbers and everything of that nature. And because, Kevin and Brian really we've had enough experiences with cash, right? We don't want cash, but somehow this got through the screen, I guess would be a good way of saying it. But she was all over. She had good control. So thank you. And I assume it all worked out okay at the end of the day.
It did.
Yeah. I don't know what you're going to do next year, but. Yeah.
So the reason why they do the last tickets by cash is because there's only so many tickets you can sell. So they do everything else with families and kids and all that before. And then what's left, they sell. But they don't want to do it electronically, they tell me, because you can have people competing coming in and the same, the system would be overwhelmed basically. So what they do is they line people up to come into the auditorium and buy their ticket, and they only take cash. So I don't like cash. It's the worst 4-letter word in our business.
What is the first selectman or the chairman of the audit committee?
But sometimes you
I
have
mean,
to
these days people buy everything I mean,
yeah, what a
you
card.
almost don't use cash anymore. Everything on a credit card. You go to get a cup of coffee, and so
It's an app.
I'm sure the McCain school system could figure out how to take a credit card for that. So, it's I don't even know who's involved, so I probably won't say anymore. But those, I'm sure those excuses or those explanations sometimes make you wonder, right? Great.
so thank you for the
Thank you.
thorough summary in the MD&A.
Yeah.
Thank you.
Compared to many years ago, I think we're
When we have
Really
one
good.
page, right? Yeah, we've come a long way.
And my apologies for not having it done. I mean,
No,
Linda
no.
did send me the
Fine,
MD&A on Saturday. It was just a few things we had to adjust.
I've always operated under the model of an auditor, if you don't need it, if the client doesn't need it to run their business, the auditor should, or the audit committee. So we're fine. We're fine. So we want to touch on a couple
So I
of
do
things.
have,
Yep.
3 more things on the MD&A, and I'll run them real quick. On page 29, proprietary funds are really the internal service funds that I think we've discussed on page, financials on page 130 to 132. And we just provide some additional explanation as to what happens between those.
Mhm.
Page 30, we kind of saw at the beginning, it goes into detail, breaking down the fixed assets and what we did with that. As I mentioned, we brought the fixed assets in-house. Joshua Kaufman has been our lead in this. He's spent a lot of work. I kind of started when Sandy was here, but I needed the additional resources, and so he's been extremely influential in getting this together and getting it in-house. We have a really good system that we moving forward.
Do we ever compare these internal records? I know the town council authorized a couple of years ago, a few $100,000 for taking inventory of fixed assets and is that just a separate system that has nothing to do with the books and records?
No, it is, and that's actually something that we are working to do now is to look at, because right now we have basically two lists. We have an internal service, a fixed asset list that we use for tracking the financials, but then we also have a fixed asset list that we use for insurance. And for the most part, they're the same, but we do want to merge to just have one list. And so that's kind of like the next task.
The goal is to merge.
Right, to combine the list, we're just working off one list. The fixed asset list is insurance.
But the insurance list was probably always there, but this was something in addition they did to figure out, you know, when was the last time the boiler was fixed and sort of the operations of the fixed assets. I remember Penny was the one that
Yeah, we
was
have
sponsored
that on the
that.
board side.
Kevin, would that be the,
Infrastructure.
yeah, the bill, that's the software that Bill has. Yes.
So that's a third system, right?
That's a maintenance
That's, yeah.
Yeah.
thing that goes out 20 years as to when things have to be replaced and stuff.
Yeah, so who used,
The engineers come in and analyze everything and then it's scheduled so you can constantly update your system to know when.
Facilities do.
for budget
Facilities do.
purposes, When does roof have to be done? When does boiler have to be done?
who used that? Tiger?
Our business, gentleman who works with Tiger.
We use
We're gonna take a
similar
look one day
system.
to see if the assets that are on there have anything to do with the assets we have on our list. It's just I mean, you know, it would be
So that is
embarrassing.
something that,
It'd be embarrassing to not have something insured or vice versa, just to do some kind of a macro check. Great. Okay, moving on.
and that's really it. And then we talked about the long-term liabilities on page 31 and the bond and where we stand with some of the bond retirement. This is just going into detail.
That's just illusionary. That's gonna go back up again, right? Yeah.
Chairman, sorry, just if I could go back to page 30, it's just an observation, the 161,000 spent on the Bristow Bird Sanctuary and the Conservation Commission raised a lot of private money as well. If you go in there, I don't know if you have, the transformation, it's just fabulous what they've done there, combination of town and private money. It's really great. It was so neglected for so long, but it's looking wonderful now.
Okay, great. Again, I think Kevin, before you're here, we acknowledge all the great work that Linda had done and told him we were waiting for him to run for state office after he finishes tidying up Norwalk, and who knows, by those days, maybe towns like Norwalk and New Canaan will merge their school systems and their financial departments, police departments, and, you know, I mean, I would imagine, well, I probably shouldn't say anymore. Somebody will be offended, so I won't. But
Joe is on and maybe you'd want to hear.
Yeah.
something.
Yeah,
Joe?
let's make sure we cover that. And there might be a couple of things in the financials that there might be a few. And you could highlight, or Joe could highlight, you know, anything in the financials that you think you want to highlight, not in detail, but anything.
So Joe, take us through the audit, where we are, any audit adjustments we might have, or any items that you see that are, you know, something we might be concerned about or be surprised about. I think we plan on meeting again on December 10th, just to look at the final draft. Hopefully it'll be a very quick meeting, and maybe it might just be easier for everybody to do it by Zoom, or we can do it in person. You know, it's I'm sensitive of people's time, but I think just given where we are, we probably ought to have a final meeting. But Joe, we'll turn it over to you. Take us through it. Much time as you need, quickly.
Very quick.
So just the highlights, I mean, unmodified opinion on the financials. You know, one of the significant things was the market. If you look at your pension asset now is about $27 million. So I'm not sure. And I think the market, last time I checked, is still a little higher than June 30. So hopefully that will hold, and that'll help your future funding costs for the pension plan at that stage.
Is there a point on the pension where you don't fund?
Yeah.
I mean,
So they're gonna run the
You,
calculation.
you don't fund it as much, or you fund maybe nothing until it indicates you should.
I mean, there's always the risk, like he just said, that if the market tanks, we could be back. I mean, if you look back at March of 2020, the pension fund value probably dropped over 30 or 40 million. And the Board of Finance was on
What are
top.
the assets that are in there?
Now we're, the market value is around 180 million,
Okay.
the highest it's ever been.
Mhm.
And I think to one of Chuck's questions about why are we referencing the July 1, 2020, it's because we do evaluation, the actuaries do evaluation every other year. So when they're publishing what the funded ratio is, that's purely looking at the unfunded accrued liability versus the actuarial value of assets. So when we look at July or June 30th, 2021, we're looking at the plan fiduciary position, which is market value based, which is why we're looking at 124%. That could go away if the right.
But, you know, it is what it is.
We shouldn't,
I
we
guess-
shouldn't,
I mean, it is what it is, and we disclosed like 120% or something in the footnote. And then in the, somewhere else in the same document, we disclose 106%.
Because of the.
Because
so-
we're a year behind, but yet,
Well, because we only do that measurement of the funded ratio, which is purely actuarial based, both your assets and your liabilities every other year. And it was interesting because in 2020, the market value and the actuarial value were very, very close. So your fiduciary net position was like 1% different. It was 105 versus 106. This year in 2021, because of the rise in the stock market and our investments, it's there's a bigger discrepancy, 125% on your plan on a fiduciary basis versus on the actuarial
so
basis.
you're way overfunded based on today's market value.
Correct.
So, you know, logically, you could reduce the funding. There's no risk to the employees because if it ever has a decrement going in the other direction, you would then have to fund this more. But I believe it's probably the case, you know, if we overfund the plan, if the town puts too much cash in the plan,
Uh-huh.
we probably can't get it back out.
Correct.
Yeah, so we would never want to, it would be lunacy to, and I use that word for the first selectman, okay? It would be lunacy it would be lunacy to overfund the plan. And, you know, the plan should be fully funded. We
yeah,
should
that was my point.
to meet our obligation, but we never would want to put more cash in, but you can't get it out.
You could even reserve the money or do whatever you do to
Yeah.
keep it, charge yourself or whatever, but maybe just not.
Set up a little
Restricted.
you set up a little fund, extra fund in the town, you know, for rainy day fund in case we're down a lot, but you don't want to put it into the fund. That would be.
Right, because then you don't get it back.
We do rely on the actuaries who are telling us
The actuary.
That was my
a few
question, was
years
just to,
out to tell us what that actuarially determined contribution should be. I think if the town has the money, they should fund that. If we don't, that would be a big red flag. Why wouldn't you fund?
Yeah, no,
but you're overfunded, that's the
if
point.
you're overfunded, if you're underfunded, then you should fund it, but if you are not underfunded, then you shouldn't fund it, and he or she is making a determination, just saying this is what the benefits are, that's one decision,
Mhm.
and then what's the asset values, and who knows what the stock market's going to do. But I do realize when you say when March of 2000, I guess, when it was 30% decrement. I mean, actually, that wasn't all that much of a decrement. It was relatively, you know, a big number.
Yeah.
But, you know, that was the day COVID was sort of announced and the
You
market
were
crashed.
rebalancing quite a bit.
Yeah, and we're back, you know, that 30% plus 40%, you know, so we're back up 70%. So, you know, I just think that's from a cash standpoint, that's something we really should be very, very careful of.
Yeah, when you talk to the actuaries coming up, I think that
Sure, well.
would be worthy of
you're more than
seeing
welcome
how
to-
you can do it without putting
You know, I
money in.
just think from the town standpoint, I mean, it's the
Agree, yeah.
finance committee's it's not the audit committee's discretion,
No.
it's the finance committee, but that's up to.
Yeah. I know we've all been involved in trying to get money out of an
Lots-
overfunded pension plan.
Chairman, can I just ask a related
It's very much,
question?
it's very much like the country club of New Canaan or country or Woodway Country Club or any club you belong to. You know, a lot of not-for-profits or a lot of clubs think that they should charge you high dues and they'll hold the money in their cash accounts just in case they need it. You know, I always believe in philosophy. I'd like to hold my own money. If you need it, you can ask for it. I'm more than happy to contribute.
It's like
You know, I don't need everybody in the
universities and
world
their
holding
endowment
my money,
funds
you know,
too.
so that's, you know, so as a taxpayer, that's what I'm saying, you know, it's, you know, we
Right.
need to, you know, so anyway,
All
okay,
right,
moving
sorry.
on, yeah. Okay.
Joe,
You had a question.
Yeah.
I'm sorry.
Related, you know, on page 30, we've gone past it. The OPIB fund is 65% funded, and which it says is substantially higher than other towns in Connecticut. So question, I don't know if this is for you, Linda, or who, number one, I mean, is there an actuarial norm or expectation as to how much it should be funded? I mean, it's nice to know we're better than other towns, but is that reasonable, 65%? Is there a GFOA norm for what it should be? Can you just talk to that, or Diane or
Sure.
someone?
So the town is currently funding for those retiree benefits on a pay-go basis. Like,
Yeah.
as their claims or their premiums, we're offsetting that. What we're doing is we're funding, there's a trust fund set up that eventually, when the corpus gets large enough, we will hopefully run the claims through that for retirees, and then, you know, their contributions will go into the trust. Right now, it's just the town funding, and we have been lowering that because the actuaries, we were contributing 500,000 every year to the trust, and I think we were down around 440 and now 400 this year, because we have been doing better on retiree health
36.
costs.
Mhm.
Again, we're going to have another actuarial evaluation for this summer, July 1, 2020. And again, because of the market improvements and interest rates rising and the stock market rising, the actual trust has done very well and that market value has gone up. So as far as the funded status of 65%, there's a lot of towns that don't even have set up a trust yet for future benefits. And I think if you look at the state, I don't want to go into details, but you know, the state has the same issues as well. And I think 65% is very good. I could imagine that we will be getting, I think already, if you look on a market value basis, we're around 80% funded.
Okay, so it's going in the right direction.
So just to close off on the pension liability, the pension liability as computed July 20th, but you know, that's a projection, so it shouldn't be all that much.
Yeah.
Oh, yeah,
Footnote,
76.
76.
Pension liability is 144 million.
Mhm.
Well, it'll be different today for sure, but you know, it's
Sure.
it's an actual projection. But the plan assets, the way I read this, is 180 million, so we got $36 million more in the fund than we need.
Mhm. But
So-
that market value was,
Sure.
you know, 35 million less a year ago. That
Well, yeah,
180.
right during the drop.
Yeah, but even at the end of, like if we go back and look at June 30th of 2020, we hadn't recouped it all. It really happened. Now,
What do you
It was
say?
38 million this year, right? Positive return.
increase, sure,
Increase.
yes.
What are you suggesting, that we should not reduce funding?
That's not my call to make. That's the Board of Finance.
No, just saying that, because right now we have $36 million more assets in there
Uh-huh.
than we need.
You know, the flip side to that, not to get into what the Board of Finance does on this, but in terms of what is the appropriate rate? The
Discount
interest is
rate.
correct,
Yeah, I mean-
because if we,
would agree 6.7, 6.5% is probably not the appropriate rate.
well, we're at 6 3/4 right now. Mhm.
That's high, but
Right.
In the
So
case
if
where
you
you're,
lower
in the
that,
case where you're fully funded, at least if you kind of use the same assumptions on your assets and liabilities, at
Right.
least it works.
right, but if you lower that to 6.5, that's going to squeeze, I mean, that's immediately going to eat into that funded
No,
status. Yeah,
I just recall 6.5. If you said 6 3/4.
we're 6 3/4.
Yeah, 6 3/4.
Anyway, it's
I was
just something to
close.
keep an eye on because, but I think the key point, I mean, ideally, what you'd like to be is even.
Mhm.
So right now you're 36 over, you know, but the next time someone talks about it, it could be 46 over or 26 over, you know, right?
Correct.
Good, okay. But one, I think the important point is that once you put it in, you can't get it out
Correct.
ever. Yeah, I know lots of companies that have worked on it, you know, I mean, there's a
Yes.
lot of legal costs spent on this. You cannot get it out.
You can't do it.
So, once you put it in, no.
Joe.
And it doesn't really benefit, it doesn't. It's not a matter of, you know, it's not a matter of, it's there and so it will be divided amongst the employees. It's there because the employees have a pension rate that's set, right?
Well, that gets negotiated. I mean, there's always in negotiations with unions that are in there, there's the trade-off between salary increases and on the flip side, police and fire who are in the plan want a higher pension benefit.
And if there's,
So
But then that's,
There's
but
more
then,
money.
but then you
There's more
fund that
money.
through future contributions.
and if there's more money in the plan.
Okay,
And
Good.
and also
One
just,
one quick question, Diane, on page 17. There's a disclosure that the fund received 2,214,000, et cetera, in contributions. Were those employee contributions or what kind of
I'm
contributions?
sorry, George, what page are you on?
Page 17.
17,
It's actually page one.
at the
of the
very,
MD.
very bottom.
Oh, yeah,
the-
oh, we went back. Okay, the plan paid out total benefits of, sure, because the pension payroll is, I mean, the cost to
The,
pay all retirees their pensions every year keeps going up. It's, you know, it was 5 million, then 5.5 million, 6 million, 6.5, because as more people retire, they're making more money than the people that retired 10 years ago. So that
So
pension
the answer
payroll,
is
if you
that,
will, is
that's all
going up.
taken.
that those contributions came from employees?
Correct.
Okay. That's all I wanted to know.
And the town. That's not all. The 2.2 million is employee contributions plus the town contribution, which was about $1,543,000.
I see.
okay. Go ahead, Joe. We're gonna go back to you.
plenty of time to.
So that was probably the most significant thing. It's one of the questions that was asked was, the other financing sources, $8 million budget, $1,300 actual. Again, the reason for that is that was the appropriation of fund balance. So that's use of savings. So it's not a financial, it's a budgetary tool only. There's no financial accounting related to that. You plan to use 8 million out of fund balance, out of savings to fund the budget. So that's why the actual is 0. The difference is the fund balance number. You didn't get the money, you already had the money. So it's not a revenue. So that's the reason. That was one of the questions that was asked. So that's the explanation for that presentation. That was on the RSI. If you wanted to go back and look at that.
I didn't know what he was talking about.
What page was that on?
What are you talking about, Joe?
I think he's responding to one of the questions. I'm not sure. Who was that question? Do you recall what the
Probably,
question was
probably
from?
me.
Probably Chuck.
Chuck.
No,
You
but
gave us
I'm
the
just trying to
most.
understand which question, because I don't fully understand it.
So many.
Page 102.
Page 102, I didn't even get that far.
I think it was highlighted on today also, so this is just so you can see.
102. No, I didn't get that far.
I
think there's
didn't.
another.
Gotta get it
Very
done early for
quickly.
us to get that far.
You can look at it in the MD&A. It's in the
You were
MD&A.
probably looking at the schedule of the MDNA, which is on page 24, Chuck.
Okay, that I
You
can,
got 24.
that I can. 24. 8 million. Oh, 8 million there. Yeah, okay. Yeah, I had a question. I did have a question, but we don't have to deal with that here as to, in the words, why there was 8 million there and then there's 1,000, which was the actual, and the words seemed to indicate that there was something different than the 1,000. That was kind of my question. So we don't have to deal with that here. You could just take a look at it.
So Joe, what about,
The
let's just-
kind of response that Diane did on Rob's comments, where he had a little note,
Oh, yes.
would be good to try to do.
On
And
that?
just say, look,
Yes.
you
I
know,
actually
changed, or,
started
you know,
that
we
last night.
looked at it and it's right the way it is, you know, whatever, would be useful.
Mhm.
Just to know that what the resolution of whatever question was. So that was good.
Some you would want it to have a bigger explanation.
Or not right, give me a call or something if
Okay.
you do want to do that.
Fair enough.
Don't kill yourself over
Okay.
it.
so Joe, let's just go quickly. Audit adjustments.
Yeah, there's, certainly some audit adjustments. So for general funds, adjustments that weren't done for taxes, the same adjustments that haven't,
Anything we should be concerned about?
nothing concerning other, it's part of the closed process. Those accounts all should be adjusted before they.
That we don't have too many, and we don't have any misses because of lack of understanding from an accounting standpoint or anything, just the normal stuff.
Yep. We'll say they're not necessarily normal. Tax revenue should be adjusted as part of the close.
There's no list or anything of,
There is. We provided a list a couple of years ago of like, here's the analysis, here's all the things you need to do as part of the close.
Yeah, I understand that, but what I'm trying to get at, just from understanding the audit close, is there,
unadjusted difference.
is there anything that's unadjusted that we should be concerned about? Number one, any suggestions you had the town didn't book, or at least you don't think they'll book by the time we get finished? And then second of all, is there anything in the way of those adjustments that indicates a level of sloppiness or a level of lack of understanding in the bookkeeping that would reflect on the controls that should concern the audit committee?
Yeah, well, that entry that I'm talking about is something, again, it's been an audit adjustment for 5 straight years. So
You mean the 99%, 99.5% on tax revenue?
we have to adjust the tax receivables not being adjusted correctly. In the general ledger, it's not being adjusted correctly.
The taxes due?
Again, what is that?
Taxes receivable is not being adjusted correctly.
So are you talking, is that more towards the year end taxes in this year that needs to be adjusted and booked to the prior year?
No, just the receivable doesn't agree to the tax office. So that
Is there a list of, let's call it unadjusted differences? Or mistakes, whatever you want to call it?
Could you put together, I think you said you did one in the past. Is it possible to put together a list? I think that's what the audit committee would like.
I mean,
to see.
normally I think you would want to see, the financial statements are the way they are. Is there a list of adjustments that weren't made?
That were made by the
That
audit.
should have been made and were passed because they weren't material, right? That would be one. The other one I think was, were there adjustments that were identified during the audit, that would indicate, like Bill said, that, there might be some issues in the bookkeeping that we ought to, know about.
Yep, there was-
Those would be kind of the two things
Work with
there.
Joe and get.
Could you give us a list? of
Yeah,
that,
we
Joe,
could,
for
I
the
mean,
next
we're gonna
meeting?
meet again next Friday, so you
Right.
could put something together and, we could look at it during the week.
Yeah, there are no past adjustments. So that's why.
There are no past adjustments.
All right, so what is this receivables that you were talking about?
Those are audit adjustments.
Okay, so what is the receivable item?
Oh, I see, audited, something that was booked, but as a result of your work, is that what you're saying?
That's what you asked about, audit. So that's a significant one that's part of the closed process that's not getting done.
So in other words, I think you're saying that there were receivables that weren't booked in your normal process. They were identified in the audit and you had to book.
And they were both post.
Is that,
Not those codes, but
is that,
audit adjustments.
is that something that happened or is that something that,
Why is it unique to tax?
why would that be?
Joe? It's a reconciliation process with the tax collector. That is not being done. So the tax collector says $2 million a road, general ledger says 2.2 million is owed. We have to adjust it every year.
Okay. So when we get together next time, maybe you could give us a little perspective as to how we might be able to avoid that adjustment in the future years, and what we can do, just to how the town can sort of bookkeep that. The good news is it gets fixed every year. The good news is we don't have an adjustment. We don't have a problem with the financial statements. If you could just give us a suggestion, how we can make sure that doesn't happen in the future, that'd be terrific.
Okay.
Good, thank you. What about any other accounting or audit issues you want to talk about?
Controls.
Just
Or
wanna
control
mention,
issues?
we only have a state single audit. The federal single audit will be performed after year end due to the ARPA monies and the federal regulations. We still have no guidance on how to audit that program. It was supposed to come out in November. It didn't come out in November, so there's no final regs and there's no compliance supplement. So we will be issuing the state single audit, which was sent out, but the federal single audit will not be completed until those regulations are issued. Because it extended the date from March 31 to September 30, 22 for it to be filed.
So this is not something that the town can control. This is something that we're waiting for rules and regulations to come out on.
Exactly.
Okay.
All right. That's the only other item I just wanted to make sure you're aware of, so.
Okay, great. So I think we're pretty well finished with the CAF report, the audit. We got to fine tune some things. We'll get together next week on the 10th.
Yeah, and in between then, like I said, if you want to,
Oh,
take a
yeah.
look, see if anything needs to be
It's gonna have
fixed
to be
and
over
just
the
let us know.
weekend.
Then we will be together on the 10th, but again, we can be in person, but everybody's welcome to be by Zoom because we're hoping that's be very, very, very quick. So since we have an announced agenda, we need to cover items 3 and 4, I believe. Because I don't think we can waive them.
Well, this is not a special need.
Okay, but I think we can cover item 3 and 4.
Yeah.
We've heard a lot about COVID expenses, but Joanne, could you just say 1 or 2 things about COVID expenses? You were happy with the process at the end of the day. It was a lot.
Heard this
It
good.
was a lot of work and we have a schedule. Is there anything else you'd like to add for us?
No, I just would like to state that we are very appreciative of the support we get from the town. We have a good working relationship with them and it enabled us to have school last year.
Yeah.
So we're very happy.
No, it's always a lot of stuff into murals and other things, but we frequently that gets in the way of recognizing the great work that all the people have done.
Thank you.
And and it really is terrific, just not here in the town, but just around the country. When you think of how many people really just stepped up in terms of getting us through this crisis, which reminds me of something I was going to talk about earlier. It's not an audit committee agenda item, but when there was this shooting in Michigan, I'm sure you're aware of it, right? I wouldn't imagine after every incident, because unfortunately there's a lot, but periodically Brian gets a group of his people together and assesses, what happened in these other schools and, to sort of make sure our readiness program is
Right.
state of art.
We have a crisis advisory board that meets monthly. There's a good number of us on it, most of the cabinets on it, the building administration, teachers, health professionals and so forth. So we have, I think, a very robust security program. We have security campus guards and we have 2 SROs on campus. And, but we take it very much to heart when we see things like this. It's very disturbing because we have the responsibility of 4,200 children,
Yeah.
800 staff members every day.
Yeah.
So
Thank
it's
you very
it's
much
very
for
hard
this
to see those
analysis, by
things.
the way.
Yeah,
I
maybe
appreciate that.
Linda or whatever could spend
I do
3
have one
minutes and
question.
take us through it.
The last column shows that we're still owed about $1.5 million. Is there anything to say about collecting that?
Sure, this is,
You want this?
Why don't you take
Yeah.
us through it quickly?
Bring it.
I have my boot on, otherwise I would.
so this is something that we've worked with the Board
Should
of
have
Ed
another
and
copy somewhere.
Joanne and her budget director, Tracy, we put together, they wanted to see a one-page summary of the COVID expenses.
Oh, I see. Yes.
And so this is the amount outstanding. And on, at least on the town side, it's timing. And so we've submitted quite a bit for reimbursement. We're waiting to receive. FEMA has a process where it kind of goes up the ranks, and then at some point you get notified that this has been approved and wait for your check or wait for the direct deposit. So that's kind of where we are, but these are numbers that are pledged. This is what we know we're going to get. It's just a matter of timing and when we get it. As I mentioned earlier, and this could be the financial report itself. It's timing. A lot of these expenses were incurred last fiscal year, and we're seeing the revenue
So-
this year. So part of that fund balance that we saw, we've been talking about.
So
we've
nothing
done-
we
So,
can
so
do
if
to
I understand
expedite
this, the left side is expenses, like the 980, let's say, right?
Yes.
And then the next one is receipts, but those are things that you've received
we
already.
Received.
Okay, and
by
then the
fiscal
other
year.
is the difference, right? And then the
Yes.
bottom left box is things that you're going to receive,
Right, and the bottom left.
as well
box,
as the
these are those
2.9,
awards,
as well as
right.
the 2.9, right?
As well as the 2.9.
So-
Yeah,
so
the
you're-
2.9 is above it. It's 2.9 plus.
Right, so you're talking about the town, which is 980, and it's, let's call it 487 short.
Right.
Of which it looks like there's 410 down below. Is that
Yes,
town?
there's
Is that
410
town?
down below that's already been approved.
And that's the
Town.
town. So that basically covers a lot of the
Covers a lot
487.
of that, and there may be some more. As I mentioned in my note, there was the president issued, I don't know, it's not an executive order, but he issued some guidance in November that said, because prior we were only getting 75% reimbursement, and now he said we should get reimbursed the full amount. And so we're reviewing all the things that were kicked out, resubmitting those, and that's not part of this, but we're estimating there could be about 400 to 500,000, according to Bill Ostman, who manages this, of additional reimbursements that could be coming to the town. But we
Right.
don't have any confirmation on that number, so that's not included in this.
And also you're receiving basically this $6 million, of which you've received 3 million.
Right.
And you're going to receive another 3,
By June 30.
and you're still working on supporting or justifying those numbers, right? On what you're going to use them for, what you say,
Correct.
and that's all part of what's
that-
still
yeah.
being worked on.
That's going through the process now. I believe the first thing is the premium pay that we were talking about. That's one potential use of those funds, but then the others are being discussed now through the various towns.
How do we record the portion that we haven't received the money for yet, the unreimbursed? In the books.
Well, so here's the thing, because Joe, and correct me here, we can only book it as a receivable if we've gotten confirmation that it's coming. Up until then, it's kind of a wish, for lack of a better word. But once we get notified that this is coming, then we book it as a receivable. But until we have that confirmation, we can't.
Okay.
And
So-
the issue last year was because of the delay in going through, we didn't know, we'd submitted 900,000 worth of reimbursements. We didn't know where that was in the
But,
process.
but let's just take the 6 million.
Right.
So 3 million is already received, but not in the June numbers.
The first 3 million is received and
It is in the
we
numbers.
got that in June 29th.
So that's there, and it's there as like a liability, right? Let's say,
It's actual revenue because we got the money. We have the money in the bank.
right, but okay.
Is that, correct me, Joe, we're talking about the first installment of ARPA.
That the first installment is recorded as revenue.
Okay,
Right.
and the second installment is not booked at all?
We didn't book that because it's a FY 23 or
Is that,
We did, it's not recorded.
should it, I mean, that's normal, I mean, that's the correct accounting to not book it?
Yes. For that payment, it should be received in June of 22.
So you don't book it until it's received, so it's not a
The cash
committed,
base, you don't book the
it's
receivable?
not a committed payment yet.
It's not earned. So if you had expenditures against it, but they're still trying to figure out what to spend it on, so it's not earned from an accounting standpoint, so that's why it's not recorded.
All right, so that's the way everybody's accounting for it, just
Is that
Nothing.
consistent across all towns, Joe?
Comes down to the whole revenue replacement thing, so.
Right.
Depends on whether that's earned. Most towns didn't spend any of that money by June 30 because everybody was coming up with a plan of how to spend it. So they're definitely not booking money that's out.
we haven't spent the 3 million either, right? We haven't spent the 3 million that we received.
Right, but we received it.
We received it.
Isn't this a reimbursement of expenses?
It doesn't have to be.
I guess,
It's not necessarily a
Take it offline,
reimbursement.
but I was, a little bit, I thought in some respects it's a reimbursement of expenses.
No, it's not.
No, it's not, that ARPA is not reimbursement of expenses.
It's somewhat like a windfall.
Looked into a grant fund.
It's new monies that's meant to stimulate, it's almost like a stimulus, but it's specifically not meant to reimburse you for expenses. It's new initiatives.
Are things leaning towards designating 3 million of it or whatever towards lost revenue? Or is that still totally up in the air?
Still being discussed.
Still being discussed, okay.
So we still have another 3 million coming.
Yes.
We ought to be in the business.
So maybe we could look at the town part of this,
The board.
Our board.
or I'm sorry,
The
the
board.
board.
Sure. So on the board side, the first few grants from last year were reimbursements. However, the grants going into this year, ESER 2 and the ARP is our planned expenditures. So
Planned expenditures for COVID,
for COVID related
going forward, so to speak. like you
things.
presumably
So
talked about
there
the
is
heat.
some for PPE, but there's also for social emotional recovery for students, learning gap and so forth. So we submitted our program plan to the state. They approved it. So now we're in the process. We have 2 years to spend the money. And the way it works in our instance is we do flow everything through the grant fund and we expend it. And at the end of the month, we request reimbursement. So in our case, it is reimbursable.
So here, like the 3.1 that shows up here for expenses.
So we're a portion of that.
Right, so this is the
Total.
Board of Ed.
3.1.
Board of Ed.
Yeah.
And then the reimbursement that we've received is 2.2, is that right?
Right, because I believe a portion of that has to do with FEMA,
Right,
and FEMA is yet to be received,
And FEMA's down there on the left there,
the town FEMA, yeah.
the town,
the
And then there's a
bottom left
separate board
box.
of FEMA.
board FEMA.
And then do the
But
reimbursement.
Bill manages it all, Bill Osman.
And then there's a whole
Reimbursements
bunch of other stuff that's still in the works that you will spend money and then you'll get reimbursed for.
Correct.
The reimbursements come back to the town since we fronted the money
Yeah, that's how it works.
with special appropriations. We increased their appropriations for the COVID expenses, so the reimbursements will come back to the town.
Okay.
Okay, I think we've got enough on that. Let's move over to,
Thank
is there anything, we don't need to go through the monthly financial reports, but is there anything that you wanted to just note or say on that because in the interest of time, I know you've got other things.
No, I think everything, at least on the town side, is consistent with where we've been. Tax collections are the primary source of revenue and they're consistent. Year-to-date expenses are trending as we typically do. There's nothing extraordinary out of the ordinary. It's
Good. Joanne, anything on?
The only thing we're looking at, we continue to look at is the health insurance.
Right. Good. Great. Okay, with that, I would like to, we're gonna have an executive session with Kevin. Or whatever we need to do to have an executive session with Kevin, I guess is close everything down, right? Is that pretty much it?
Yeah, Tucker will shut down but you're gonna adjourn when you come back out of executive session. You have to vote to go into executive session, have a discussion, and then vote to come out of executive session, and then vote to adjourn.
Okay, so can we have a vote?
So you have to come back.
I don't think, look, you don't want Linda to join us now.
No, I just,
Linda, so we'll continue to go through our comments and you can share probably electronically. I don't know if there's any way in which.
okay.
Is there any way for revision marking?
Motion to go into an
Is there
executive
any way for
session.
revision
Second that,
marking in
George.
the
I do
document?
second that, yes.
You're all in favor of that?
So that you'll be
And
able
you're
to
in
see
favor of
what
that?
changes were
Okay.
made.
Thank you, Tucker. So we're back in general session. We went to executive session on a personnel matter with the first selectman. We've accomplished that business. So I think there is Any of, I don't think there's any other business that we have to go through.
I move we adjourn.
I second that.
Thank you. You're in favor?
I'm in favor.
So we're adjourned.
Okay.
Thanks, everyone. Have a nice
Please-
holiday.
Please come Monday for,
Yeah, we'll
London
try to
if you
do
can.
that. Yeah.